Welcome to the Deep Dive. Today we are focusing on one of the biggest names in financial infrastructure, BNY Mellon. Their full year 2025 and Q4 earnings call on January 13th was, it felt like a critical turning point.
Absolutely. For years, management has been talking about this idea of rewiring the entire firm.
Right, transforming a legacy custodian bank into a modern fee-driven technology utility.
And that's the core narrative we're really dissecting today. Our mission is to move beyond just the headline metrics and find the hard evidence that this multi-year transformation is actually working.
So the big question is, did they just hit their numbers, or did they fundamentally change their operating model?
Exactly. And what do their newly raised, very aggressive financial targets tell you about management's confidence moving forward? It's a huge tell.
Okay, let's unpack this with the numbers first, starting with the big picture. Full year 2025. The results were record-breaking.
They really were.
BNY reported revenue of $20.1 billion, growing a very robust 8% year over year.
And that top-line strength drove a record net income of $5.3 billion.
The revenue growth is strong, but, the real story for me is the discipline underpinning that growth.
That's it. Expenses grew only 3% year over year. And that gap, that's the engine of the entire transformation story.
When your revenue grows that much faster than your costs, you generate what's called positive operating leverage, or POL.
Yeah, and what was that POL number? Because that's the real signal of the change we're talking about.
On a reported basis, they delivered 57 basis points of POL, but, and this is the standout figure, if you exclude the one-time or notable items,
it jumps, right?
It jumps to an astonishing 411 basis points. That tells you this isn't just about selling more in a good market.
No, it's successful, large-scale cost restructuring. It's confirmation that the rewiring of their back office is really, truly paying off.
And that operational consistency is so key, isn't it? They highlighted achieving 8 consecutive quarters of positive operating leverage.
That's the rhythm. It shows a sustained performance, not just a one-off market benefit. It just validates the entire management strategy.
Precisely. And on the metrics that matter most to shareholders, reported earnings per share, EPS, grew 28% year over year to $7.40.
And the key profitability measure for banks, return on tangible common equity, or ROTCE, that came in at a remarkable 26% for the full year.
Those are just premium returns for a financial platforms company of this magnitude.
No question.
Now, zooming into the fourth quarter specifically, Q4 2025 continued that momentum. Total revenue was $5.2 billion, up 7% year over year.
And fee revenue, which is really BNY's bread and butter, was up 5%.
Within that fee segment, investment services fees really popped, didn't they? They grew 8%.
Yeah, and that growth was driven by 2 key things. Higher market values, helping their assets under custody, and critically, net new business wins and higher client activity.
So you've got both a favorable market and execution tailwinds.
Exactly. That combination is what you want to see.
Net interest income, NII, that also remained supportive. It hit $1.3 billion, a 13% jump year over year.
The sequential growth there was interesting, up 9% quarter over quarter, because a lot of banks are seeing their deposit margins compress right now.
Clients moving to higher yielding products.
Right. But BNY Mellon managed to offset that compression. They did it by reinvesting maturing securities at higher yields. So basically capitalizing on the current rate environment through smart treasury management.
And let's just talk about the sheer scale of the operation for a second. Assets under custody and or administration, AUCA, reached $59.3 trillion.
It's just a staggering number, nearly 60 trillion. It underscores their critical role in the whole global financial ecosystem.
And a big signal of confidence in their forward cash flow. They returned $1.4 billion of capital to shareholders in Q4.
Which is a 100% payout ratio for the quarter. EPS, if you strip out the notable items, was $2.28, up 21%.
So the numbers clearly confirm the success of what they're calling phase one. But let's move into the strategic conversation now, because these results are just a reflection of their rewiring strategy.
Yeah, what are the 3 pillars driving this whole thing forward?
Well, the strategy hinges on clients, running the company, and culture. The client pillar, though, that seems to be the most powerful measure of their commercial success right now.
It is. It's all about operating as one BNY.
And one BNY basically means selling multiple services across different divisions to the same client, right?
Exactly. And the proof is, in a data point they really hammered home. A 60% increase in clients buying 3 or more services over just the last 2 years.
That's a huge jump. That deep entrenchment is crucial. When a client uses that many services, the switching costs become massive.
And that's the sticky relationship that drove their reported 3% organic fee growth in 2025. That organic number is the proof that the cross-selling model is actually working.
It makes the whole firm much more resilient. They also talked about how they are running the company, simplifying the platform's operating model, which now covers 70% of their people.
You see that reflected directly in the expense control we were just talking about.
We saw some concrete examples of this integrated model in their Q4 client wins, too.
Yeah, take Wisdom Tree, for instance. BNY is providing a whole banking as a service solution, bundling payments, custody, digital assets.
It shows clients want that one-stop shop for complex infrastructure.
And another one, Jupiter, the active asset manager, they chose BNY for a full front-to-back suite of capabilities, everything from a trading settlement to accounting.
But the biggest structural change they're betting on is technological, isn't it? The AI push.
Oh, absolutely. Management explicitly views AI as a superpower, a catalyst for fundamental transformational change, not just, some narrow efficiency game.
This is where BNY starts looking less like a traditional bank and more like an infrastructure software provider.
Yes. Their enterprise AI platform is called ELISA. They designed it to be kind of general intelligence and capable of multi-agentic functionality.
So it can use different AI models at the same time and act on its own on complex tasks.
Exactly. And they aren't just building this in a vacuum. They've integrated collaborations with major tech players like Google Cloud's Gemini and OpenAI to help with their deep research and data-intensive work.
And they gave us a quantifiable metric for the productivity gains, which was fascinating.
Yeah, in 2025 alone, BNY deployed over 130 digital employees.
These bots are handling structured tasks, like validating payment details, remediating code vulnerabilities.
Think of it as 130 full-time efficiency multipliers rolled out in a single year. That low 3% expense growth suddenly makes a lot of sense.
And connected to that innovation pulse is their progress in bridging traditional and digital assets. This is where the rubber meets the road for institutional adoption.
What's really fascinating here is their positioning. They are the first U.S. global systemically important bank GIP to offer digital asset custody.
That GIP designation is huge. It means they're deemed so massive that their failure could risk the global financial system.
So this custody move signals a real level of regulatory comfort, with BNY being a key player in digital assets.
They also launched the Drive for Stablecoin Reserves Fund and partnered with Securitize on a tokenized AAA CLO strategy.
Yeah, it seems like they're creating the products that address the real-world operational challenges of managing these new kinds of assets.
And maybe the most forward-looking thing. They took the first step in deposit tokenization. They enabled an on-chain mirrored representation of client deposit balances.
Right, and that doesn't just put client cash on a blockchain, it makes deposits programmable, which could massively improve how institutional clients use their cash internally. They are literally laying the rails for a truly integrated digital economy.
Okay, let's pivot to the segments, because while the overall performance was strong, it really varied, didn't it?
It did. And security services is the clear outperformer.
Absolutely. Investment services fees in that segment grew 11%. But the most crucial metric of operational success is this.
The PTM. The pre-tax margin for security services hit 33% for the full year.
Which blew past the medium-term target of 30%, they said, way back in 2021. That is tangible evidence of over-delivery.
And where's that growth coming from?
It's coming from the high-growth corners of the market. Alternatives AUA up 10%, including double-digit growth in private markets, and ETF AUCA just soared 34% year over year.
So their infrastructure is geared perfectly towards capturing the most complex, fastest-growing asset classes.
Now, moving to markets and wealth services, that segment achieved an eye-opening 49% PTM in Q4.
That business is extremely mature and very capital efficient. Clearance and collateral management fees were up 15% year over year.
And on the Pershing side, which serves advisors and broker-dealers, net new assets were $51 billion in Q4.
And management also said, very confidently, that the M&A-related deconversion activity that had been a headwind is now largely behind us.
That's critical because it means the massive Pershing platform can now focus on aggressive organic growth.
Okay, now let's talk about the laggard, which management themselves identified as the greatest opportunity. Investment and Wealth Management, or IWM.
Yeah, the PTM here was only 17% in Q4. That's well below their prior medium-term guide of 25%. This is the execution risk, isn't it?
It is the weakest link, and it absolutely deserves critical scrutiny. This segment has been suffering from cumulative net outflows.
Right. BNY is primarily an institutional infrastructure player, but they need this segment to perform to realize their overall margin expansion strategy.
The management team is essentially drawing a line in the sand. They're saying they expect 2026 to be the year IWM sees improved financial performance, driven by strategic streamlining and key hires.
But what does that streamlining actually entail? And how can they quickly reverse chronic outflows? That's the real challenge.
It is. The streamlining basically means focusing on higher margin mandates and aligning their product offerings more closely with the strengths of the One BNY platform.
But they need to show, and show quickly, that those key hires, the new talent they brought in, can stabilize the flows.
If they fail to execute here, hitting those ambitious new overall company targets becomes significantly harder. This is where the market will demand tangible proof over the next 2 quarters.
That's a great point. They have to prove they can fix the one segment that relies on traditional investment performance, while the rest of the company just leverages its tech and infrastructure. Okay, let's address the elephant in the room. The forward guidance and these bold new targets. For 2026, they're still holding that positive operating leverage line, targeting greater than or equal to 100 basis points.
And they provided pretty specific projections for 2026, which shows a new level of conviction. They expect total revenue to grow by approximately 5%.
While expenses are planned to grow only 3 to 4%.
And they even broke down that 5% revenue guide. They're expecting NII to be slightly ahead of 5% and fee revenue slightly below 5%.
So the message is clear. They believe they have enough internal operational levers to self-fund investments and expand margins, even if the market backdrop is just okay.
Given all this confidence, they didn't just meet their old medium-term targets, they completely blew past them and raised the bar dramatically.
This is the highlight of the entire call. It's the signal that phase one is truly complete.
The management team explicitly raised their new medium-term financial targets by 500 basis points across the board. The pre-tax margin target is now 38%, up from 33%.
And the return on tangible common equity, the ROTCE target, is now 28%, up from 23%.
Wow. A 28% ROTCE target for a company of this size is a serious, serious statement.
But they went a step further, calling these new targets the floor for their ambition. Isn't that a classic executive move to, sandbag? How much confidence can we really place in that?
It's aggressive, but when you look at the 411 basis points of POL they just delivered, it suggests they have found deep, permanent efficiency in their operating model that they didn't anticipate when they set the original target.
So the market needs to take that floor comment seriously.
I think so, especially because their revenue model is diversifying so rapidly. They're projecting a trajectory that moves them from a legacy institution into a much higher margin financial infrastructure platform.
Shifting to the investor context, BNY is pitching its case around the resilience of its diversified platforms. They're arguing they've diversified their revenue engine to reduce sensitivity to any single macro factor.
And if you connect this to the bigger picture, BNY is essentially the plumbing for several long-term structural mega trends.
Right. They listed the growth in capital markets,
which their corporate trust and payments divisions service. Then the explosion in alternatives and private markets, the structural growth in wealth, the digital assets transformation, and the persistent demand for outsourcing.
These are all multi-decade tailwinds, and BNY is uniquely centered to service all of them.
Okay, let's talk balance sheet and capital discipline, crucial for any large financial player.
Their capital philosophy is unchanged. They're maintaining a very conservative Tier 1 leverage ratio, targeting 5.5 to 6%, and managing to the upper end of that.
Given their highly generative, capital-light business model, they expect the total payout ratio for 2026 to stay around 95 to 105%. Capital generation is not a problem for them.
And finally, on M&A. With all this internal transformation, are they looking to go out and buy something?
They maintain a very high bar. They're open-minded if an acquisition can accelerate their strategy, but the key phrase was that they have no pressure to execute deals.
Because the organic momentum is so strong.
Exactly. That optionality is a huge strategic advantage. They don't have to overpay for growth because they're generating it themselves.
Now we turn to our segment. This is not financial advice. We take the insights from the call and pitch a high-conviction, potentially aggressive trade idea straight from the internal hedge fund pitch deck.
And the core thesis here is simple. The market is failing to re-rate this company correctly because it's still viewing BNY Mellon as a cyclical, balance sheet-heavy traditional bank.
I agree completely. The pitch is a long-term bullish structural trade on BNY Mellon based on the eventual realization of that newly raised 28% ROTCE target.
The thesis is that BNY is transitioning into a capital-light, fee-driven tech utility, and its valuation should reflect those higher recurring revenue multiples.
The market currently values BNY against its peers in the banking sector ETF. It's trading on that XLF beta.
But the outrageous rationale is this. That 64% increase in clients buying multiple services, plus the deployment of the ELISA AI platform. That combination creates significant, permanent, embedded operating leverage optionality that the market just is not pricing in.
If they can sustain that organic growth while simultaneously achieving, say, 400 basis points of cost efficiency from AI tools like ELISA, they are effectively manufacturing a higher, more stable margin profile.
And a full realization of that 38% PTM and 28% ROTCE target, which management calls the floor, that will force a material re-rating of the stock.
So the trade thesis is to go long BNY now.
Yes. Because once the market accepts that 28% ROTCE is sustainable across a market cycle, BNY will trade less like a traditional bank and more like a high-growth fintech or an exchange infrastructure player. That unlocks significant shareholder value through multiple expansion.
The combination of the sustained cross-selling and the AI-driven efficiency gains is just too powerful to be ignored by the market for long.
So what does this all mean? The key takeaway from this deep dive is that BNY Mellon has successfully concluded phase one of its transformation.
The consistent operating leverage and the confidence to raise their medium-term targets to 38% pre-tax margin and 28% ROTCE prove the strategic narrative is translating into financial reality.
Execution was strong in security services, and that one BNY commercial model is driving real change, but all eyes are now on IWM to deliver in 2026.
And here's a final provocative thought for you to mull over. The true potential of their AI platform, ELISA, is still completely unknown. Management has framed it as an internal capacity and efficiency tool. But given the new focus on product and innovation, how quickly can BNY turn ELISA from an internal capacity multiplier into a new revenue-generating scalable platform that they offer directly to their vast institutional client base?
That's the question.
If they can productize that AI, that would unlock the next wave of margin expansion that even this new shiny 28% ROTCE target doesn't capture.
That potential shift from cost center to profit center is definitely the next structural inflection point we need to track. Thank you for diving deep with us. We hope this analysis gives you the edge you need.
Be well, and we'll catch you on the next deep dive.